For more on what this fear resounding in the marketplace means for investors and the bond market, we turn now to Greg Peters. He's head of fixed income and economic research at Morgan Stanley. Greg, you just heard Scarlett paint the picture of what's happening with Libor right now. It seems like on an interbank basis there is some concern about lending right now. Are we pricing in a European bank failure at this point?
No, look, I think focusing on the funding markets is critically important, don't get me wrong, but I think it's being overplayed somewhat, honestly. So if you compare it to where we were in 2008, where Libor was, close to 4.5%, we're at 53 basis points today. So yes, it's resetting higher, it's something to watch, but we're nowhere close to where we were in 2008.
Yet it seems that credit costs are what's the driving force in the markets around the world right now. Is that misplaced? Is that what you're saying?
No, look, I don't think it's misplaced per se, but it's very different. So what we're focused on is the unsecured market, so what the bank debt market is pricing. So credit spreads and CDS spreads of the various financial institutions, which is showing much more concern around solvency, actually. But as far as funding goes, which we think is the ultimate transmission mechanism of contagion, the central banks globally, I believe, will do anything that they can to keep that market open. The difference today is the price is just increasing. It's not dramatic, but it's just increasing, which isn't such a bad outcome ultimately.
Yet you would have those who point to, say, the euro-yen cross, just an indicator once again that there is truly a lack of confidence and a sense of fear out there. At this point, at which point do we put the fundamentals and the technicals aside and just look at a situation where fear begets fear and that becomes the reality?
Well, I think that is a reality of today, and so I would characterize today as quasi-capitulation today. It's just the uncertainty around Korea, the banking system at all is really starting to manifest today. In my mind, today might actually mark somewhat of a bottom. We've been negative on the markets since February, and it looks like at these lower prices there is this jettison of risk that might actually ultimately stabilize the market.
Okay, so if this is a bottoming, what do you do right now? How do you position yourself?
Well, we would tactically start to add risk in here, I think. Now, the tricky aspect is that it is month end, so I'm not sure if it's today, tomorrow, next week, or whatnot, but it does feel like it's a bottoming process. So we would start to add risk, particularly here in the U.S., where the Treasury market is telling you that it's about double dip and deflation, and quite frankly, we just don't see that yet. So we would look to add risk here in the U.S., not only in the credit markets, but also the equity market. And honestly, we're still quite negative on the Eurozone, so we're short the euro for sure. What
does risk mean to you? Are you looking at emerging market debt, which by comparison looks a little bit safer perhaps than developed market credit at this point?
Well, yeah, well, it does. That's been the quote-unquote safe haven trade, which is somewhat, ironic for sure, as they externally fund. But no, I'm talking about even high yield market looks pretty attractive to us at these much lower prices. It's not to say it'll continue to go down near term, but it looks much more attractive risk reward here. As well as even, U.S. equities don't look terrible in here right now.
What about European equities? Would you buy European banks?
Well, European banks is a whole different story. I think that is really the central issue here. So, no, we're still quite negative on the European banks. And in fact, we've had this pair trade on all year long where we're long U.S. financials, short European financials, and that's worked pretty well.
All right, Greg Peters joining us with some important perspective this morning. Thanks for joining us.